Hi, this is Nate Williams from Practice Financial Group. A lot of you know me, and some of you might recognize my voice because I'm the co host of the podcast Just Say No to the DSO. Now, any of you who know me and are familiar with the work that I do know that I am trying very hard to educate doctors on the financial component of selling your practice to a DSO or OSO. And I'm trying to educate you on why this could be the single worst financial decision you ever make to sell your practice. So recently, a client of ours sent to me a podcast done by a very popular orthodontist making the claim that if you sell your practice and you take the money, the cash that you get at closing, and you invest that money, 20 years later, you're going to have a lot more money and it's going to really accelerate you to retirement. And the numbers that this guy threw out were you sell your practice, you get $3 million after tax, and you invest that at 10% return. In 20 years, you're going to get $20 million, and how that's going to be this huge boon to you and such a smart thing to do. Okay. And in his example, he was saying you have a $1 million EBITDA practice. So just right off the bat, I want to say that this claim, that this idea is totally false and it's a really bad, stupid idea. Okay. So let's think about this for a minute. The guys who are backing these OSOs and wanting to buy your practice, are they stupid or are they smart when it comes to business and investments? They're smart, right? They're not dummies. And what are they doing with their money? Are they taking their money and investing it in the market and buying index funds? Or are they taking their money and trying to buy orthodontic practices or oral surgery practice, endo practices, whatever? And they're doing the latter. Why? Because if you can own an ortho practice, that's going to be a way better investment than owning a publicly traded company. Now, I'm a huge advocate of investing in the market. I invest a lot of my own money and our clients' money in the market, in publicly traded companies. But it is not a superior investment to your own practice, your own dental, orthodontic, whatever the specialty is, practice. That is by far your best investment. And that's what I want to talk about today. So a couple of years ago, one of our orthodontic clients, big practice, got offered $20 million for his practice. I talked about this particular example in the podcast, and I want to come back to it today because it's a great example, and it was a big sale price, right? And so this doctor, I'm going to analyze the deal after 5 years, should he sell this practice, because it was a 5-year work back, which almost all offers are. And then I'm also going to look at this, well, what if he invests the cash that he gets at closing and he invests that in the market? I'm going to look at that too. And I'm going to let you decide which one of these is the better option, to sell or to not sell and retain ownership. So this guy was offered $11.5 million at closing, cash. That's a pretty big number. He was also offered a $5 million earnout bonus that would come in $1 million per year for the first 5 years if he hit these revenue target numbers. Now, interestingly, in year 2, he needed to hit $6 million of revenue. He actually exceeded the 5-year target of $7.5 million in year 2. So this guy was pretty happy he didn't sell to the OSO, but that's neither here nor there. So 5 years of earnout bonus and then $3.5 million of equity. So those of you who have heard me talk know that you'll hear me say that the equity is worth whatever the DSO tells you it's worth. So what they're going to do is they're going to give you a certain number of shares, and you have no idea how many total shares outstanding are there in the total OSO. They're just going to say, we're going to give you this number of shares, and they're going to call it worth, in this case, $3.5 million. But you have no idea how many shares you're getting, what are the voting rights of those shares, what are the OSO's ability to dilute those shares. So this number right here, this $3.5 million of equity, is a very suspect number. And the only way to get any kind of real analysis around that is to compare, would I rather have this equity in the OSO, which is going to be a small fraction of my own practice, or would I rather have 100% of the equity in my own practice? So there's kind of a qualitative analysis that needs to happen there, because nobody knows, only God knows what this equity is actually worth until you liquidate in the future and they give you dollars, right, in exchange for your equity. So at closing, 11.5 million. This guy's going to pay taxes of a total of $3.5 million. I allocated 90% of this to goodwill, just in my hypothetical analysis, which is very generous. That's taxed at the lower capital gains, federal and state capital gains rates. If there were no state, then this would be zero. Let's just say no state capital gains. And so he's going to get this capital gains of just that. And then 10% of the purchase price is going to be taxed at ordinary income tax rates. So the net after the net cash at close is $8.6 million. So in the example in the podcast that was sent to me, it was, what if you get 3 million? And in my example, I'm going to go way above that. I'm going to say we're going to take 8.5 million and invest that. And where does that get us? And then over the next 5 years, he gets $5 million earnout. This guy was going to get compensation of $1.75 million. This was written into the LOI that he would get these compensation amounts for his services as the orthodontist in the practice. For total compensation, less taxes, gives him a net after-tax compensation of $4.2 million. So the total cash for selling this practice, $12.8 million. Okay? So that's what this guy gets if he sells the practice in 5 years, total after-tax compensation, $12.8 million. So now let's look at what would he get if he just retained ownership of the practice. And for that, we go down to this analysis. So here's revenue in the first 5 years. This was dictated by the DSO. I told you already that the revenue in year 2 far exceeded this. This is a big practice, 2 locations, multiple doctors working in it. So this practice has fixed overhead. This was the fixed overhead from the financial statements and tax returns that we prepared. This is the doctor comp. Here's the variable overhead. So this right here is the EBITDA of the practice, which is revenue minus fixed overhead minus doctor comp minus variable comp. Now the other associate doctors, their compensation is buried in the fixed overhead right here. So here's the EBITDA of the practice. Now this particular doctor is running perks of about $300,000 through. So that's a generous retirement contribution, spouse on payroll and her retirement, kids on payroll, travel, CE, meals and entertainment, things like that. Not entertainment so much anymore, but meals. And so this is the taxes that this doctor will pay. And here's the total income net of tax for the doctor, which is the doctor comp plus the EBITDA minus the taxes. This is the total compensation to the doctor if he retains ownership of the practice. So in this guy, in the first 5 years, I project that he was going to earn $10.8 million. So let's just stop right there and compare the $12.8 million cash that he gets if he sells to the $10.8 million that he gets if he retains ownership. So the total, so he gets $2 million more in cash if he sells, right? So that's a win for selling the practice. Plus he gets the equity value of selling the practice. So you could say that the true sales price of the practice was $2 million plus $3.5 million of DSO equity. There's a sticker price of $20 million. But we know that they're going to give him a bunch of cash up front. Then he's going to pay them back a bunch of cash in the first 5 years that he's worked. I've explained this a lot of times, and most of you understand this already. So the true sales price of the practice, $2 million plus $3.5 million of DSO equity. So let me ask you this right away. In year 5, you've got an ortho practice generating $7.5 million of revenue with EBITDA of $3.4 million. Would you sell that business for $2 million plus $3.5 million of DSO equity? I don't know anybody in their rational mind who would. Here's another thing to consider. The cash gap, the cash gap at year 6 is $2.1 million. That means in year 6, that's the amount of EBITDA that the practice is generating. And this is the amount of the owners get the EBITDA. So this is the amount of money that he's kissing goodbye forevermore. Okay. So, so yeah, even at 5 years, selling this practice for $2 million and $3.5 million of equity is a horrible, horrible business decision. But let's continue the conversation, right? Because the math that we haven't seen is what happens if you invest this 8.6 million. So what I did is I extrapolated for the next 15 years after the first 5-year sale, and what would have happened in this practice if he just retained ownership. And so I just took the year 5 numbers and I increased those by 3%. I'm just assuming a 3% average inflation. Okay, so by year 20, this 7.5 million is actually 11.6 million. Now that's not necessarily growth, that's just inflation adjustment. And I'm inflating the costs, the doctor comp. I significantly increased the doctor comp, and I'm saying the owner doctor is going to get 25%. So I've got the EBITDA, and I've got the total. So the EBITDA of the practice is this, and here's the total income net of tax to the owner doctor. And anyways, let's go and look and see where he would be at in 20 years. So if he invested the 8.6 million, which was the sales price, at the end of the year one, he's got 8.6 million, but the next year he's going to get a 10% return on that money. So he's going to have 9.4 million. And 20 years later, as this keeps compounding, he's going to have $52 million. So this is a much better example than the 3 million turning into the 20 million. $52 million if he sells the practice, invests the 8.6. Wow, compound interest is really amazing. However, if he retained ownership, and this is why the OSO doesn't want to invest in the market, they want to invest in this practice, is because if he were to retain ownership, then he gets the EBITDA minus the taxes that he would pay on the EBITDA. So after year 1, that's 1.3 million, which is this EBITDA less the tax owed on the EBITDA, right? So at the end of year 1, he's got 1.38 million. At the end of year 2, he's going to invest another 1.5 million. So he's going to end up with 3 million, 5 million, and so forth, which is just the prior year time, get the 10% return plus the new invested amount from the EBITDA net of tax this year. I hope you follow this. At the end of 20 years, if this guy retains ownership of the practice and invests all of the EBITDA net of taxes, he ends up with $94.8 million. So I'm not an expert by any means, but I know that 94.8 is $42 million more than the $52 million that he gets if he sells. Now you might be thinking, this is just funny money. Yeah, this is the power of compound interest, but it also shows that the concept of sell your practice and invest that money in the market and you're going to be better off, that is the biggest lie and is the biggest bunch of salesmanship and misinformation that I think I have ever heard. And I've heard a lot. That one tops it all. You could say that to this doctor, selling the practice was a $42 million mistake. So the claim that he's accelerating towards retirement, total bullcrap. Anyways, as you can see, these kind of misinformation and lies that people tell in order to get you to sell, in order to get a commission on the sales price, it really bothers me. And anyways, to you honest doctors out there, I hope this is helpful in understanding why I have been saying over and over and over, just say no to the DSO or OSO. Hope you have a nice day.